Welcome to GRE. I'm your host, Keith Weinhold. Happy New Year. What is the most important question in the entire investing world? It is a vital one, and this coming year makes it as relevant as ever. Asking yourself this question and answering it can make you wealthy, and you probably never even heard this question before. That and loads of financial education today on Get Rich Education. Mid-South homebuyers, with over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your return on investment as their North Star. It's no wonder smart investors line up to get their completely renovated income properties like it's the newest iPhone. Headquartered in Memphis with their globally attractive cash flows, Mid-South has an A-plus rating with the Better Business Bureau and 4,000 houses renovated. There is zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate with an industry-leading 3.5-year average renter term. Every home they offer you will have brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and wait for it, a high-quality renter in an astounding price range, $100,000 to $150,000. Get to know Mid-South. Enjoy cash flow from day one at midsouthhomebuyers.com. That's midsouthhomebuyers.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Lake Champlain, New York to Lake Charles, Louisiana, and across 188 nations worldwide. You're listening to one of America's longest running and most listened to investing shows. I'm your host. My name's Keith Weinhold. I am grateful to be here myself. Thank you for being here. And you aren't here for me, you are here for you. So let's build your wealth today. What's the most important, vital, essential, an almost mandatory question in the investing world today? While you think about that, let me build some context so that it makes sense. Now, why don't we discuss stocks on this show more often? In fact, when most people hear the word investing, they might think of stocks first. Their mind might shoot there immediately. And then when someone refers to the market, they just simply say the market. And they typically mean the stock market, like the Dow Jones Industrial Average or maybe the S&P 500. Look, with persistently higher interest rates, it is likely that economic headwinds are still coming. Now, what if things got worse than a recession and we entered a depression? I'm not saying that it's likely, but let's look at what can happen, because this actually has happened. What can happen in a depression? The stock market falls and doesn't recover for 25 years. Oh, that's not a guess. That really happened in the United States. Yes, the Dow Jones peaked in 1929. The market crash hit. These were the times of the Great Depression. Stocks lost almost 90% of their value. Yes, 90%. And that means after a loss like that, a beating like that, stocks would have to rebound 9 times or 900% just to get back to even after 25 years. Well, I told you that the U.S. stock market crashed in 1929. The Dow didn't fully recover until 1954. And yep, 1929 to 1954, that is fully 25 years of zero gain. It has happened right here in the United States, the most powerful nation in the world. Well, you might wonder, oh, come on, could that really happen to any major stock market in an advanced economy today, in these more modern times? Even if things got really bad, come on, can that even happen? Oh yeah, things don't even really have to get bad. Understand what's going on right now. The third largest economy on earth, still to this day, is Japan. Japan's Nikkei peaked in 1989, and it still hasn't recovered from that high 34 years ago. Yes, that's the main stock market index for Japan, the Tokyo Stock Exchange. That is still going on right now today. It still hasn't recovered back to its 1989 level. In fact, it's not even close today. So it doesn't even take a depression for those stock market calamities to occur in major world nations' stock markets today. And what's the difference between an economic recession and a depression? The short story is that a recession is a substantial downturn in one nation's economy, and an economic depression that is widespread across a number of nations. And there are some other distinctions. And right, the old joke is that a recession is when your neighbor loses their job, and a depression is when you lose your job. Well, what about real estate? Real estate values, they don't always go up. What happened to real estate in its ugly downturn about 15 years ago, where we had a mortgage meltdown from these liar mortgage loans and a glut of housing supply, neither of which are happening now, by the way? During the ugly global financial crisis in and around 2008, 2009, well, during that time, from its peak, real estate went down 19% nationally. Yes, on a nominal basis, the national median home price was down 19% from $257K down to $208K. That's it? Maybe you're thinking, that's it? 19%? Yeah, this is when everything seemingly was going wrong for housing, and even then it didn't reach 20% bear market territory 15 years ago. Of course, some markets did better and some markets did worse. That's a national number. And by the way, I will put the link to that chart that shows this in the show notes for you. And yes, we really do put links in the show notes for you when I tell you that we will. You can see that at getricheducation.com/430. This is episode 430 of the GRE podcast. So just go to getricheducation.com/430 to see today's resources and today's show notes. Also, you have access to an entire transcript of today's show, all of the lyrics today, just like we do for some of our episodes here, so that if you have a deaf or hard of hearing person in your life, they can, I suppose, read today's show rather than listen to it. Or maybe you want to read along as you listen, or read after you listen in order to reinforce your learning. Now, at the start of the recession in 2008, the national median housing value was $234K at that point, and it took all of but 4 years to recover and exceed that level again. Yes, from the start of the GFC, housing values only took 4 years to recover. And the source of all this information that I've been telling you about is the Census Bureau and HUD, and that piece of data as well is also available for you in the show notes at getricheducation.com/430. So the point is that real estate or stocks can lose value, and that real estate is substantially more stable. If you buy real estate in a good market and you have an average or better property manager, meaning that the property manager is just okay with screening tenants, then you can sleep pretty well, because it is hard to lose big in that situation. And you might not even be in real estate for the capital value of it. You might be in it for the cash flow anyway. So what we're talking about here is this is helping you build context and provide you with a clue about the most important question in the entire investing world that I'm going to share with you soon. And while you're still pondering what that question might be, I'm going to build more context for you so that this question makes complete sense. And let's start to isolate it here. Real estate builds wealth. Stocks, although they can maintain wealth for you after you've built it if you're really good with keeping your emotions out of stocks. But you've got to build it somewhere first. Stocks aren't known for building it. So that's why this most important investing question today is not about stocks. Well, what about stocks or mutual funds that are in a retirement plan? Now, is that more relevant, or an ETF in a retirement plan? Come on, enjoy the compounding growth on pre-tax dollars and all of that. Take stock's 10% return, and like I detailed 2 episodes ago, adjust that down for inflation, emotion, taxes, fees, and volatility, and what do you have left? I'm not going to detail that since I just did that 2 episodes ago. I'll tell you what the key question is not. How can I max out my retirement plan? Oh, geez. The new annual contribution limit to 401ks this year is $22,500, by the way. And I'll admit, I used to have a day job and I maxed out my retirement plan for a few years before I realized that maxing out my retirement was minimizing my present and sacrificing my overall life. So maxing out my retirement was minimizing next year and minimizing next decade and minimizing my life for decades until I hopefully was not just alive, but actually healthy enough to truly enjoy deferring my quality of life all of those decades. Maximizing your retirement contribution, that means you're living a smaller life for decades guaranteed. The risk of delayed gratification is denied gratification. Now, there's a little something to be said for delayed gratification, for the psychological benefit of you having something saved for the future, even if it certainly diminishes your life in the near term. Well, instead of all that, with income property, I discovered that I can invest in something that pays me an income stream today, not takes an income stream away from me, like a conventional retirement plan, pays me an income stream today without jeopardizing my future one bit. In fact, it also makes my future better at the same time because I'm paid an income stream today and I will get a better return than my 401k long term, and the tax benefits are there as well. This works when you're prudently leveraged. Well, today's mainstream media, though, they tell you that it's a bad time to buy real estate because prices and interest rates are up in the past year, but they are talking about primary residences. Instead, with rental property, your tenant pays all of your mortgage principal and all of your interest for you and all the operating expenses on the property and hopefully a little on top of that called cash flow. So the question, how do I max out my retirement? That is not a great investing question. You're contemplating how to defer your quality of life, delay your standard of living on time you're never going to get back, and live a life of less. Now, here's another bad question. I heard a teenager say this recently. I want to attend my dream college, or I guess the question form is, how can I attend my dream college? Dream college? What? I mean, college is still necessary for some skilled professions, but like we touched on last week here on the show, the value of a college degree is down, yet the price of a college degree is up, and that's basically why enrollment has been steadily declining at colleges since 2012. But even worse, how do I attend my dream college? Who would even ask that question? Now, it could matter whether you have a degree or not, but no one cares what school you went to. No one cares what your college grades are either. Look, the last time that you went to go see the doctor, do you feel like you got a good quality of care for them or not? I mean, that's what you really care about. Did you want to know what college or medical school your doctor graduated from before you saw them? Do you even know what college they went to? See, it doesn't matter. Did you ask your medical doctor about what their college grades were? See, they don't matter either. Now, I actually don't think college is a complete waste, despite all that. I got a 4-year degree, and I did learn some things, but it probably was not the most efficient use of my 4 years. But dream college, who cares? That is not a good question. Attend my dream school, that makes no sense. Here's a third question that is not the best question that you can ask yourself in investing today. This is an awful question. How can I become a millionaire? Ugh, awful question. I think that longtime listeners know where I am going with this one, but let me update it because we have had some substantial inflation for almost 2 years now. Let me tell you, you don't want to be a millionaire. The definition of a millionaire is not someone that makes $1 million a year. It is having $1 million net worth. So if you add up the value of all of your assets and it totals $1.5 million, and then you add up the sum of your debts and that is $500,000, Well, your net worth is 1.5 million in assets minus a $500,000 in debts, which equals 1 million. There you go. That's millionaire. That's not where you want to be. Now, maybe if you're 75 years old and you think you've got 10 years left to live, you could live a somewhat modest life on $1 million. You'd have to be sure that you don't run out. So that might even get stressful. But as you can see, this is not where most people want to be. Inflation has rendered the term millionaire nearly to middle class now. The middle class is getting eaten by wages that don't keep up with inflation. So a single dollar millionaire, that will probably be a poverty marker within my lifetime. Now, if you're a millionaire that has $200K of cash flow each year, oh, well, that's different. That's better. Now you're starting to ask a different question. You're starting to ask about residual income. So net worth, that's not as important of a financial measure in your life as your residual income stream. But just a millionaire, wrong trajectory. Avoid, avoid, avoid. So maxing out retirement plans, attending a dream college, or setting out to be a millionaire are all losing financial plans. They are all losing life plans. We're talking about building some context and eliminating some paradigms, as I will soon posit the most important question in the entire investing world. There is one question that can make you wealthy, and you probably never heard this question before. And if you act on the answer to this premium best investment question to ask yourself, you're probably not going to have money concerns for the rest of your life. I think it'll all make sense when I reveal it later today. While you're thinking about it, I've been building some context and a foundation about why this question matters and why the other ones don't. Hey, and if you're new to the show, again, I am Keith Weinhold. I'm a 20-year real estate investor in the United States and a little bit outside the United States. I am an active member of the Forbes Real Estate Council. I write all of our articles on GetRichEducation.com as well. I'm also a financial columnist for the Epoch Times. I host this weekly Get Rich Education podcast every single Monday, this show right here. We don't miss shows. I have never missed a week, and we also don't replay old shows. Fresh material here for you every single week. Yeah, did you know that? Every week. I don't tend to get sick. I don't have any allergies. I didn't get caught up in the pandemic. I never had any symptoms there or anything. We just keep playing straight through here. Most every financial influencer has been here with me as a guest on the show, running alongside me, including Robert Kiyosaki, Grant Cardone, Jim Rickards, Chris Martenson, T. Harv Eker, most anyone that you've ever heard of. And besides writing for GetRichEducation.com, Forbes, and the Epoch Times, I also write our weekly Don't Quit Your Daydream newsletter that I write myself and send directly to you. And then I am the talent, if you can call it that. That's what it's called in the industry, the talent. That makes a slackjaw like me feel uncomfortable saying that out loud. I am the talent on the Get Rich Education YouTube channel as well, building your wealth over there. I also host webinars to help you get started with real estate. That's where you and I go look live at actual addresses together and more. That's something that we just began a few months ago. I'll tell you more about the webinars in some future episodes. I am also your instructor for a fast course that I made specifically for you at GetRichEducation.com/course. Those 5 course videos that average just 12 minutes each, they could comprise the most powerful and impactful 1 hour of investing in education that you're ever going to see. That's free. Again, that video course at GetRichEducation.com/course. When you know what you're doing in real estate, you're often getting paid 5 ways. And when you're profiting like this, you're not tempted to cut corners. And when you're not cutting corners, you're providing others with good housing. So let's do good in the world together. Provide good housing, and let's abolish the term slumlord in this nation. So that's the mission that we're on. Everything that I do here is completely free for you. Every single thing that I just mentioned is free. So if you like our mission and our mindset and our direction, doing the right thing before you do things right, I invite you to subscribe to our show here now. You don't have to, but consider it. Subscribing to the GRE podcast on your podcatcher is the only way you're certain not to miss one wealth building show. Much more next. I'm Keith Weinhold. This is Get Rich Education. If you're looking to grow your passive income from real estate, pay attention. My Property Stats is a deal analysis tool developed by an active investor to cut the time it takes to analyze any deal by over 90%. For any real estate class, you can calculate the exact price to pay to hit your cash flow and IRR goals. Build a world-class pro forma. Calculate the most you should pay for a renovation. Run multiple scenarios with a comparison tool and more. My Property Stats is the all-in-one toolkit for real estate investors. That means more deals, more cash flow, and more returns. Go to mypropertystats.com/GRE now and use the coupon code GRE to get 10% off your first year. That's just $90 a year for a tool that can save 10 hours per deal. No more spreadsheets, no more juggling multiple files. Use coupon code GRE to get 10% off at mypropertystats.com/GRE. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com.
This is the Millionaire Mind's T. Harbecker. You're listening to the powerful Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to GRE Podcast 430. I'm your host, Keith Weinhold. We are in our 9th year of coming at you every single week, 52 weeks a year. There is one question that can make you wealthy, and you probably never asked yourself this question before, or perhaps even heard this question before. And if you act on the answer to this premium best investment question to ask yourself, you probably won't have money concerns for the rest of your life. It begins with keeping your emotions separate from investing. When it comes to buying a long-term rental property, some of the worst advice that I've ever heard is only buy a rental property if you would live in it yourself. Oh, that really limits your ability to put the most profitable income properties into your portfolio. Now, of course, you had better only buy a primary residence that you would want to live in yourself, but it's definitely not that way with income property. It is not that way with rentals. You do still need some standard here, though. Look, years ago, I had a friend that saw me as a successful real estate investor, so he wanted me to tag along with him to go out and tour rental properties on a few weekends so that my experience might inform him on which property to buy and which ones to avoid. I kind of enjoy doing this kind of thing. Most of the properties were unsuitable. We're talking about unsuitable single-family rentals, unsuitable condos, unsuitable duplexes and triplexes and fourplexes. But we found one together, a fourplex that I thought was suitable, and yet he didn't, even though he hadn't invested in real estate before. And the reason that he didn't like this, it was about a 1980 built fourplex building, somewhere in there. The reason he didn't like it is because although it was well kept, some of its finishes looked dated. One of the 4 units had a pink color themed bathroom. It did look kind of funky. It had this sort of weird looking pink wall tile and pink sink and pink bathtub. Everything matched though, but yeah, it looked dated. And another one of the fourplex unit bathrooms had those same bathroom fixtures, but it was in a dated olive looking green. It was probably the original tile bathroom. And then the third bathroom, a light blue. And then the fourth was just a totally renovated new bathroom. And it didn't matter that the bathrooms didn't match each other because each family in the fourplex had their own unit in these 2-bed, 1-bath fourplex units. And here's the thing, that building was well kept. It was fully occupied and it had a good history of occupancy. That's why the fourplex checked my buy box, but my friend didn't want to buy it because he just couldn't get over the emotions that he felt in looking at that, say, pink bathroom. See, he couldn't see himself living there, but he was not going to live in the fourplex himself. He would be an investor that lived off-site. Well, this whole thing didn't make any sense to me. He gave into emotions and he didn't buy it. He lost out on a profitable property. So when an investor says that they wouldn't live in an income property themselves, my response to that is often, oh, well, I didn't know you planned to live there. Because oftentimes the investor does not. So emotions got the best of my friend, and he didn't buy this property that would have been a winner. Now, here's another case, a different one. Being sentimental, that's an emotion. I've known someone that strongly considered buying a rental property in their own neighborhood, chiefly because they used to play basketball at that house back when they were a teenager. Oh, geez, that's an awful investing strategy. Investing is about facts and not feelings, and certainly not the feelings that are evoked because you slam dunked a basketball for the first time on an 8-foot rim when you were 13 years old. Ugh, dreadful investing strategy. Would that property's income exceed its expenses? That's what I would want to know. So, sentimental feelings, they are truly an emotion when investing is about the facts. Now, we're building some backstory and context. We are hitting close to home for what I want to reveal is the best investment question that you can possibly ask yourself. Now, it's pretty likely that you want to avoid buying property in a badly blighted, crime-ridden neighborhood that's also trending in the wrong direction, and that's even if the property is cheap. Because in those areas, it's hard to find a respectful rent-paying tenant, and in those areas, properties could depreciate in value at the same time in tough neighborhoods. Actually, you typically want to avoid beautiful neighborhoods too. Yeah, avoid beautiful. That can sound really unusual to newer real estate investors, but for long-term rentals, beautiful does not correlate with profitable. The rents aren't high enough there. So depending on your target market, to go from a working class neighborhood where the numbers often make sense to an upper crust neighborhood, rents might triple, but purchase prices could 10x. So that is a losing formula for you. So because you want to avoid rough neighborhoods and avoid beautiful ones, what you want to be attracted to are working class, safe enough neighborhoods that are just a little below the median home price, like I talked about a few episodes ago. You don't want to go so low that you're beneath the safe bar. Ask about some things like, well, what are the condition of the cars like in the neighborhood? If someone would park a car, like a decent car, outdoors overnight, well, that's one sign that the neighborhood is safe, but that isn't all you need. You're going to look at crime and school district data and things like that you can find online. So again, don't let emotions prevail, and also don't let personal preferences dictate what you do too much. And here, this next thing I had to tell you, you're going to learn some funny quirks about me. I've spent my life living in places that have a real change in seasons, including a substantial winter each year. For me, that's mostly been in Pennsylvania and also Alaska. But distinct seasons are my personal preference. Yet I know that a lot of people don't care about seasons. They just want year-round warmth. So that's why I invest in the Sunbelt states, because I know that that's what others want. So it's not about where I want to live. It's not about me. It's not about my emotions. I also know that even people that dislike the cold, they will still live in a cold place if they have a job. Money is very attractive to people, and money trumps climate and other lifestyle things for some people. So it can be good to invest in growing pockets of, say, the Midwest. Personally, I don't prefer to live on hardwood floor. It's harder, colder, and noisier than carpeting. I prefer plush, padded carpeting, and I've got some reasons for that, but I know that I'm in the minority on that one. In fact, we actually did a poll recently on our Get Rich Education Instagram stories, and 83% preferred to live on a hard surface, only 17% on carpet. But see, in my rentals, I use hard surface flooring, either vinyl plank flooring or hardwood laminate flooring, even in the bedroom sometimes. It's not only more durable, but tenants actually seem to prefer it, even if I can't figure out why. So I keep my emotions out of investing. I'm keeping sentimental reasons out of investing. And I'm even keeping my own personal preferences like plush wall-to-wall carpet out of investing. Stick with facts and demographics and good infrastructure and migration trends and jurisdictions that have strong protections for landlords. See, that's the stuff that matters. So with all this in mind, what is the best real estate investing question that you can ask yourself during the course of your entire investing lifetime? That question is, will this property secure an income stream? Yeah, that's the big question. And it is unemotional. When you ask yourself, will this property secure an income stream for yourself? Now you're accounting for the quality of tenant that you can attract there with that question. Now you're accounting for the long-term building maintenance question. And now you're accounting for if you're in a good market with enough job and population vibrancy for a long-term tenant base. Those are the substantive things that really matter, all encapsulated in the question, will this property secure an income stream? Oh yeah. And what makes that question multi-dimensional is that even though the word property is in that short question, the question is really asking more about what supports the property, like the metro economic market and the neighborhood that it's in. See, if you take a modest 1950 built tiny 500 square foot studio apartment, that can support an income stream for you if it's in a thriving job market with a future. Well, as far as your investing for the year ahead, we are still here in high inflation, although it's come down, and a lot of people feel that a recession is ahead. So what do? Where do you invest in times with high inflation and a potential recession? Well, something like gold, that's the classic inflation hedge, but long term, its price merely tracks inflation. So though it could be good to have a little, and it could be a good place to store wealth, if you have a lot of wealth, it's not going to grow your prosperity. It doesn't have a track record for doing that. Bitcoin, that has been beleaguered in this brutal, ongoing crypto winter, as they call it. And Bitcoin does have a few redeeming attributes, in my opinion, like I've talked about on some previous shows, but Bitcoin is risky. In fact, during the global financial crisis of 2008, the pseudonymous creator, Satoshi Nakamoto, was just publishing his Bitcoin white paper. We really don't have any history of what Bitcoin does in a prolonged recession. And here's the thing, if there's a bad recession and you lose your job, what are you really going to need in your life badly? You're going to need more income streams, like a durable real estate income stream. And you know what? You're not going to be able to get a loan for property anymore if you lose your job. So if high inflation persists, as any longtime listener knows, real estate absolutely crushes it when you get income property with a loan. And yes, by now, you know that you win the inflation triple crown, winning with real estate 3 ways at the same time. Come on, by now you can recite those 3 ways with me. Asset price inflation, debt debasement, and cash flow enhancement. Yeah, that is the inflation triple crown. And this is why rental property with a loan is the singular best investment in high inflation and a potential recession. It's probably the best investment in either one of those conditions, and it's true when both conditions persist. History over hunches. Real estate has proven itself historically. You can have a hunch, but it's typically best to look at what happens historically over and over and over again. My big question for you today is, will this property secure an income stream? That's the key investment question. But over the years, I've learned that you also have had a question for me. And your question for me is something like, yeah, okay, well, where do I find the properties conducive to securing an income stream? And these are exactly the types of income property that you can find now. at GRE Marketplace. That's a resource that our team and I put together for you, where I share the same exact property providers with you that I purchase property from myself. My gosh, I wish a resource like this would have existed 20 years ago when I bought my first rental property through a real estate agent that didn't know what they were talking about, and I wasn't even aware of it at that time. And it is free to sign up, just like thousands of investors already have. There is no subscription fee, and just one login gives you access to all of the property providers, and they're typically in the profitable Midwest and South. You don't have to invest in your own local market. You don't have to limit yourself that way. The best deals usually are not there. When you open up your investing possibilities to the entire nation and even beyond, you are no longer limiting yourself. And see, when you're limiting yourself and you buy in a market with a strong rent income and a low purchase price, what have you just done? You have made your investment profitable. How are you more incentivized to think when you're profitable? Well, you don't cut corners. Those that have thin margins or no profit, they're incentivized to cut corners. Those that aren't making money on the rentals, people like that, they can be tempted to cut corners and, for example, not replace faulty electrical outlets or not replace rickety porch stairs. When you invest out of market and you've increased your chances of being profitable, you're less likely to do those slumlord types of things, and that's how this is congruent with our mission to do some good in the world here. But let's be frank, it's not complete altruism. You want to be a profiteer like I do, so I buy from these providers myself at GRE Marketplace, and prices over there, they're often discounted because this is a direct model. There's no real estate agent for either side to have to pay at all. And we even video interview the property managers in the markets there for you, since that property manager can manage the property on day one for you if you so choose, making this largely passive. So armed with this best ever question of will this property secure an income stream, understand the GRE Marketplace is not like a big box store. It's more like an organic farmer's market where we help match you with experienced property providers. And a lot like an organic farmer's market, you check back regularly for new offerings. It's a vibrant market. Check back every few weeks. Make this the year when you take action and think big with income property. And hey, I'll see you over there. I've got a video for you over there too to help walk you through GREmarketplace.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.